In 1986, a savings and loan institution in Texas collapsed. Then another. Then another. By 1989, over 1,000 American financial institutions had failed, wiping out the savings of millions of ordinary Americans and costing taxpayers $130 billion. It was the largest financial collapse in American history at that point. It was bigger than anything that had happened since the Great Depression. But that's not the crazy part. The crazy part is what happened next. Federal prosecutors launched the most aggressive white-collar crime investigation in American history. They assembled task forces in every major city. They subpoenaed records. They flipped witnesses. They built cases, and then they prosecuted. Over 1,000 bankers, executives, and financial professionals were convicted of crimes related to the savings and loan crisis. Over 1,000. Some of them went to prison for decades. Charles Keating, the most prominent figure in the scandal, was convicted on multiple counts of fraud and racketeering. The crazy part is that 19 years later, the 2008 financial crisis was dramatically larger. It wiped out more wealth. It destroyed more jobs. It caused more suffering. It was more clearly the result of deliberate decisions made by identifiable individuals at specific institutions. The evidence was documented in emails, in internal memos, in congressional testimony. The misconduct was arguably more egregious, more widespread, and better documented than anything that happened in the savings and loan crisis. And the craziest part of all? After the 2008 financial crisis, the number of senior bankers who went to prison for their role in causing it was exactly one. Out of the entire global financial system. Out of every bank, every rating agency, every mortgage company, every hedge fund that participated in creating the conditions for the worst financial crisis since the Great Depression. One person went to prison. A mid-level Credit Suisse banker named Karim Sarageldin, who had hidden losses in a trading book. By the end of this video, you are going to understand exactly what changed between 1989 and 2008. What decisions were made, what laws were changed, what institutions were defunded, and what cultural shifts occurred in American law enforcement and regulatory culture that made the prosecution of 1,000 bankers possible after a smaller crisis, and the prosecution of almost nobody possible after a larger one. This is the story of how America stopped prosecuting financial crime, and what it cost everyone. To understand the savings and loan prosecutions, you need to understand what savings and loan institutions were and why their collapse happened. Savings and loans, also called thrifts, were a specific type of American financial institution that had existed since the 19th century. Their original purpose was simple and genuinely useful. They took deposits from local savers and used those deposits to make home mortgage loans to local borrowers. They were community institutions, deeply embedded in local economies, and they were heavily regulated to ensure they performed this function safely. The system worked reasonably well for decades. Then, in the late 1970s, inflation destroyed it. Savings and loans were locked into long-term mortgages at fixed rates of 5 and 6%, while inflation was running at 10 and 12%, and depositors were demanding higher returns on their savings. The industry was technically insolvent. Congress decided to save it by deregulating it. The deregulation of the savings and loan industry in the early 1980s was one of the most consequential policy errors in American financial history. Congress allowed savings and loans to invest in almost anything: commercial real estate, junk bonds, direct equity investments, exotic financial products. They raised deposit insurance limits, meaning depositors had less reason to scrutinize what their institution was doing with their money. They relaxed accounting standards, allowing institutions to appear solvent longer than they actually were. And they reduced regulatory oversight at the very moment they had increased the risk-taking capacity of the institutions being regulated. The result was a wave of reckless and, in many cases, outright criminal behavior. Savings and loan executives used federally insured deposits to make loans to themselves and their associates. They created circular transactions that generated paper profits while building up real losses. They paid themselves extraordinary salaries and dividends from institutions that were technically bankrupt. They bribed politicians for regulatory protection. The fraud was pervasive, brazen, and well documented. The government's response was equally aggressive. The Federal Home Loan Bank Board, which regulated savings and loans, referred thousands of cases to the FBI and the Department of Justice. Congress appropriated funds for dedicated prosecution task forces. The FBI deployed hundreds of agents specifically to savings and loan fraud cases. The Department of Justice created specialized units with experienced prosecutors who understood financial crime. The prosecutions that followed were unlike anything American law enforcement had attempted in the financial sector. Prosecutors did not settle for civil penalties. They did not accept deferred prosecution agreements. They did not allow institutions to pay fines and admit no wrongdoing. They built criminal cases against individuals, from the executives who ran the institutions, to the accountants who signed off on fraudulent statements, to the appraisers who inflated property values to enable bad loans. Charles Keating ran Lincoln Savings and Loan in California. When Lincoln collapsed, it cost the federal government $3 billion and wiped out the savings of 23,000 investors, many of them elderly people who had been sold Lincoln bonds on the representation that they were as safe as insured deposits. Keating was convicted of racketeering, fraud, and conspiracy. He was sentenced to 12.5 years in prison. He served 4.5 years before his conviction was overturned on procedural grounds, and he eventually pleaded guilty to lesser charges and served no additional time. David Paul ran SunTrust Savings Bank in Miami. He used depositor funds to purchase a Rubens painting for his office, to renovate his yacht, and to fund a lavish personal lifestyle while his institution was insolvent. He was convicted of 68 counts of fraud and sentenced to 11 years in federal prison. He served 5 years. Don Dixon ran Vernon Savings and Loan in Texas, which became known as Vermin Savings because of the extraordinary level of fraud within its walls. Dixon used depositor money to fund a fleet of aircraft, a beach house, an art collection, and a European vacation for himself and associates. Vernon collapsed with losses of over $1 billion. Dixon was convicted and sentenced to 5 years in prison. These were not isolated cases. The pattern repeated across hundreds of institutions in dozens of states. The prosecutions were not perfect. Some convictions were overturned. Some sentences were reduced. Some executives received lighter treatment than the facts seemed to warrant. But the fundamental principle that individuals who committed financial crimes would face individual criminal consequences was enforced consistently and visibly. What made these prosecutions possible was a combination of institutional will, legal tools, and regulatory infrastructure that had been built over decades. The FBI had agents who understood financial crime and had the time and resources to investigate it thoroughly. Federal prosecutors had experience with complex financial fraud cases. Judges understood the law. The regulatory agencies that referred cases to prosecutors had the institutional memory and the staffing to build the evidentiary foundations that criminal cases required. Then something changed. Not in one dramatic moment, not through a single decision, but through a series of choices made over the following 2 decades that systematically dismantled the infrastructure that had made the savings and loan prosecutions possible. The first change was the defunding of white-collar crime investigation. The FBI's white-collar crime division had been staffed up significantly to handle the savings and loan cases. After the crisis resolved, those resources were not maintained. Then came September 11, 2001. The FBI was reorganized to prioritize terrorism and national security. Thousands of agents who had been working financial crime cases were reassigned. The institutional expertise that had been built up over decades was dispersed. By 2008, the FBI had roughly 1/3 of the financial fraud agents it had deployed during the savings and loan crisis, despite the American financial system being many times larger and more complex. The second change was the development of the Deferred Prosecution Agreement as a standard tool for resolving corporate crime. Deferred prosecution agreements allow the Department of Justice to enter into an arrangement with a corporation whereby criminal charges are filed but not pursued as long as the corporation meets certain conditions, typically paying a fine, implementing compliance programs, and cooperating with ongoing investigations. If the corporation meets the conditions, the charges are eventually dropped. The theory behind deferred prosecution agreements is defensible. Criminally convicting a major financial institution can have systemic consequences that harm innocent parties, including employees, shareholders, and customers, who had nothing to do with the misconduct. The Arthur Andersen prosecution demonstrated this problem. When Arthur Andersen was convicted of obstruction of justice in connection with the Enron scandal, the firm collapsed within months, destroying the livelihoods of thousands of employees who had no involvement in the misconduct. But the application of deferred prosecution agreements to financial institutions after 2008 went far beyond managing systemic risk. It effectively established a policy of institutional immunity. Major banks paid billions in fines through deferred prosecution agreements, while no senior executives faced criminal charges. The message sent to the financial industry was clear and precise. The institution might pay a fine. The individuals who made the decisions would not go to prison. The third change was the shift in how the Department of Justice approached financial crime cases in the post-2008 period. Under Attorney General Eric Holder, the DOJ explicitly articulated what critics called the too big to jail doctrine. The idea that some financial institutions were so systemically important that criminally prosecuting them would cause economic damage that outweighed the benefits of prosecution. This doctrine was never officially stated in those terms, but it was clearly reflected in the pattern of decisions made. When the DOJ's own investigators and prosecutors built cases recommending criminal charges against major financial institutions and their executives, those recommendations were repeatedly overridden at senior levels of the department. Career prosecutors who had spent years building cases found their work shelved. The institutional culture shifted from asking, "How do we build the strongest possible criminal case?" to asking, "How do we resolve this in a way that doesn't destabilize the financial system?" The fourth change was the evisceration of the regulatory agencies that had served as the pipeline for criminal referrals during the savings and loan crisis. The Office of Thrift Supervision, the primary regulator of savings and loans, had made thousands of criminal referrals during the 1980s crisis. By the 2000s, regulatory agencies across the financial sector had become increasingly captured by the industries they regulated. A phenomenon that accelerated as agency budgets were cut, and the revolving door between regulators and regulated institutions spun faster. Agencies that had once aggressively referred cases to the DOJ became more focused on civil penalties and consent orders. Administrative remedies that did not require the evidentiary standards of criminal prosecution, and that allowed institutions to resolve issues without admissions of wrongdoing. The pipeline of well-developed cases flowing from regulators to prosecutors dried up, and without that pipeline, the DOJ's ability to bring financial crime cases was severely diminished. The consequences of this shift have been profound and ongoing. The failure to prosecute individuals after the 2008 financial crisis sent a signal throughout the financial industry that the personal downside risk of taking excessive risks, misleading investors, and violating regulations was essentially zero. The worst that could happen was that your employer would pay a fine that shareholders would ultimately bear. Your bonus would not be clawed back. Your freedom would not be threatened. This signal was received and internalized. The financial industry's behavior in the years following the 2008 crisis, the continued mis-selling of financial products, the manipulation of interest rate benchmarks like LIBOR, the foreign exchange market rigging, the continued use of tax havens and shell companies to evade regulatory requirements, reflected an industry that had concluded that the expected cost of misconduct was tolerable. The contrast with the savings and loan era is stark and instructive. During the savings and loan prosecutions, the knowledge that individual executives would face personal criminal consequences changed behavior. Institutions that might have engaged in risky or fraudulent behavior were deterred by the credibility of enforcement. The prosecutions were not just about punishing past misconduct. They were about creating incentives for future compliance. In 2013, then Attorney General Eric Holder told the Senate Judiciary Committee that the size of some financial institutions made prosecution difficult because of the potential impact on the national economy and global financial system. This admission was remarkable. The chief law enforcement officer of the United States was publicly explaining why the largest financial institutions in the country operated under a different set of consequences than individuals and smaller businesses. Senator Chuck Grassley responded by noting that this meant some institutions were above the law. Holder subsequently tried to walk back the statement, but the pattern of non-prosecution spoke louder than any clarification. The singular exception is instructive. Kareem Sarageldin was a managing director at Credit Suisse who concealed losses in a trading book during the financial crisis. He was sentenced to 30 months in federal prison. He was not a CEO. He was not a board member. He was not a senior executive who had made strategic decisions about the direction of a major institution. He was a mid-level trader who had done something criminal within a system that was doing much larger things that were arguably equally criminal and faced no criminal consequences at all. His prosecution did not represent a commitment to financial crime enforcement. It represented the path of least resistance. A mid-level employee without the resources to mount an extended legal defense, without the political connections to create friction in the prosecution process, without the systemic importance to trigger too-big-to-jail concerns. He was prosecuted precisely because prosecuting him was easy. The hard prosecutions, the ones that would have required confronting institutional power and navigating complex systemic risk concerns, were not pursued. The savings and loan crisis produced over 1,000 criminal convictions. The 2008 financial crisis produced one. The difference was not in the severity of the misconduct. It was not in the quality of the evidence. It was not in the clarity of the applicable law. It was in the political will, the institutional capacity, and the cultural orientation of the enforcement system toward financial crime. America built the infrastructure to prosecute financial crime during the savings and loan era. It then systematically dismantled that infrastructure over the following 2 decades. When the largest financial crisis since the Great Depression arrived, the infrastructure was gone. The expertise was dispersed. The institutional will had been replaced by a doctrine of systemic deference. And the people who made the decisions that caused the crisis went home to their bonuses. Over 1,000 bankers went to prison after a smaller crisis. One went to prison after a larger one. The difference is a choice. A series of choices made by identifiable people in identifiable institutions over identifiable years. Choices that can be made differently if anyone chooses to make them. If you believe the public deserves to know where the money actually goes, subscribe. Every week we cover the frauds, the scandals, and the financial crimes the system would rather you forget.